Welcome back to CNBC TV 18 Prime. You're watching the Global Reset. Today, we turn the spotlight on SEBI's newest innovation in India's capital markets, specialized investment funds or SIFs. These products aim to bridge the gap between traditional mutual funds and alternative strategies by giving investors access to both long and short opportunities in a regulated structure. We'll be joined shortly by Quant's Sandeep Tandon, the first mover in this space. Sandeep, welcome to the program. But before I come to you, Sandeep, let me quickly set up for the uninitiated in terms of our viewers who'd like to know a little bit about what SIFs are, right? So just a quick primer here. Now, specialized investment funds are SEBI's latest innovation, a new category that combines the trust and transparency of mutual funds with the sophistication of a hedge fund like strategy at least. For the first time in India, retail and HNI investors can access long-short opportunities in a regulated fund structure. Now, you may ask, what's the difference between this and, of course, the mutual fund, the traditional mutual fund? Now, traditional mutual fund investors only benefit when the markets rise. SIFs introduce flexibility. Managers can short stocks or sectors expected to underperform, now offering a chance to generate returns even in a falling or sideways market. Now, the real advantage is, in a way, resilience. By combining longs and shorts, SIFs can deliver steadier performance across bull and bear markets, and of course, also in range-bound phases as well. They also open up new sources of diversification, giving investors a smoother ride, perhaps, compared to pure equity exposure. But investors must also be aware that this is not a simple SIP kind of a product. The use of derivatives and shorting brings some layer of complexity, and outcomes depend heavily on the money manager's skill. Minimum investment is higher, of course, as we highlighted. The graphics tell you that as well. And risks of volatility and drawdowns, of course, remain like other products. Globally, similar strategies are known as liquid alternatives. They have gained traction among investors seeking hedge fund style returns with mutual fund like accessibility. Now, India's specialized investment framework adapts these models, ensuring regulatory protection while introducing global sophistication as well. Now, are these products, is the SIF for everyone? They may be, and of course, we'll ask Sandeep more about this, they may be best suited for experienced investors, slightly HNI kind of investors who also want diversification beyond traditional, straightforward, plain vanilla mutual fund products. And of course, these are people who can ride out short-term volatility in search of better risk-adjusted returns. Now, at least 10 Indian and foreign AMCs, including Quant, ICICI, SBI, ITI, are actively preparing to launch these long-short SIFs, targeting investors. Firms such as Edelweiss, Mirae, Nippon, etc., are in advanced stages of seeking approval. Sandeep, great to have you with us here. Thank you very much. Apologies for that short primer for our viewers, and congratulations. You're the first off the block in terms of getting approval. And I know you're pretty excited about this product, Sandeep. So let's just start there. What about this product are you most excited about? And tell us, let's just start there. Basic thoughts.
See, Prashant, the way I look at this product, obviously, first of all, thanks to SEBI to give this sort of opportunity to the market. See, globally, if you really look at the hedge fund are very popular product, or sometimes people call it market neutral product, or low walls product, or beta neutral product. There are various names. Okay, what is important to understand, these products technically or mathematically, if I have to say, can bring down your overall volatility of the portfolio. Basically, it can bring down the beta of the portfolio or any deviation. Up to a certain extent, is technically you are able to reduce the risk. Okay, and that is very important to understand, that some portion of risk can be reduced, and that's the reason globally these products have gained a huge amount of popularity. And we have to keep this aspect is also mind, whether this sort of product can be comparable with the mutual fund. The way I look at this space, I think instead of looking at these products in isolation, I think I look at the combination. If any mutual fund investor has a mutual fund portfolio, our recommendation is that you should also build SIF portfolio also. Combination gives you a better approach. Like if you have both mutual fund and SIF in your portfolio, then it reduces the overall volatility, the drawdown will be in the lower side, and then you're also talking about additional source of alpha which can be generated by the shorting. Okay. Now, again, with a lot of caveat, we'll say, yes, you can go wrong on the shorting side also. And that's the reason the money manager skill set is very important. The analytics which we use is very important. Now, if you really look at globally, when we talk about low frequency versus high frequency, like when you talk about mutual fund, they are traditionally known as long accounts. You know, that you have complete canvas and it's completely discretionary on the money manager to do whatever they feel like. But when you talk about the SI part, obviously you're trying to look at the moment you say I'm going to have a low walls product or less beta product, then we're talking about bringing down the risk, which also means that you can't rely on the low frequency indicator. You have to use a lot of high frequency indicator like derivative instrument or derivative strategy, which has its own advantage from a risk perspective. And you can bring down the risk also of the overall portfolio if you are combining both the products.
No, absolutely. This is, Sandeep, would you say this is slightly heavier on the quant side or not necessarily in terms of how this is managed?
See, obviously, if you are trying to generate something, if I like to call it absolute return product, a lot of people look at or the deeper return product, so then you are forced to participate through derivative instruments. When you were talking about that, you have options to use or hedging option to the tune of 25% short you can do. Basically, you're talking about you have luxury to have a 25% short position in the market, which means you are dependent on a derivative instrument in a big way. And hence, your risk mitigation framework has to be proper. Your risk control has to be proper. The risk department plays a very dynamic role when it comes to SIF. So, one way of looking at that you have more risk, but other way of looking at it is that you can control your risk. That's the way we are talking about how to introduce a systematic active investment thesis with the help of new SIF. That's the one something we are trying to explain people how you can bring down the risk systematic.
Is this, again, just scratching the surface and we'll go into details. Is this comparable to AIFs which offer long short strategies as well? But of course, available to people with a smaller ticket size? I mean, is that a decent analogy to use?
Yes, you can actually compare with the AIF. The only difference between AIF and the SIF would be in the AIF, you are allowed to have a leverage position. You can have two times exposure, where in the SIF, SEBI does not allow to have more than 100% exposure, which means you can technically you cannot do any sort of leveraging. The first differential. Second, obviously, is the you are getting the tax efficiency of a mutual fund vehicle. You are getting a transparency of mutual fund, better regulatory environment. So if you look at, I think the way I defined SIF, it has taken the both the benefits of a mutual fund and the as well as the AIF. You have taken the flexibility and agility of AIF, and you have taken the taxation benefit and the transparency of the mutual fund side. So it's a great combination if you can use it properly.
And the tax treatment is exactly the same as mutual funds, Sandeep, right?
Absolutely same. So the way equity taxation is there for equity scheme, debt taxation for debt scheme, and so is the hybrid, the other categories. It remain exactly the same thing.
Got it. And you know, for do you? I mean, you are the first off the block in terms of receiving an approval. What are Quant's plans? By when are you looking to launch your product in the market?
So we are launching our first product, the equity long short fund on 17th September. We are planning to launch that product. It's already announced. So that's the first product coming from the industry perspective also. And we are pretty excited because in the environment which we are in, these type of product actually timing can't be even better. The way we are also explaining, we have seen an extraordinary bull run in, let's say, in last 4 5 years from 2000 till 2024 has been a raging bull run sort of thing. And obviously, the mutual fund portfolio, 100% long portfolio will be the biggest beneficiary. If you have this product, let's say in 2020, definitely it could have underperformed the mutual fund product because it has some amount of hedging aspect or some amount of shorting thing. But the type of environment which we are in right now, when we are saying that easy phase of bull run is over, we are in difficult phase or challenging phase of the market, but we are very clearly saying we are in bull run. We are in decisive bull run, but in difficult phase. In difficult phase of bull run, these type of product will actually generate alpha also, and you bring down your drawdowns also. So that's the reason we as a mutual fund house are advising our investor to look as a combination rather than just looking in isolation.
You know, is there a comparable? I don't know. I don't think AIFs you can use. I'm just trying to understand compared to long run mutual fund returns. is there a data set for, not, obviously SIFs are new, but a comparable asset class where we can look at historical returns, these kind of strategies on a long run, what kind of returns do these kind of strategies provide? Is there a way to do it?
Yeah, if we can, we have done some work, but only thing I'm not a great believer of doing some back testing and thing and then coming out because the when you operate in real life environment is very different. The only thing which I want to say out here, if I compare the SIF versus mutual fund scheme or SIF strategy versus mutual fund schemes in different environment. So let's take if you're a raging bull run, then obviously mutual fund scheme will outperform the SIF. And I'm talking about relative comparison between SIF and mutual fund. We're not comparing with the peers or the benchmark. So I'm just talking about relative benchmark. And if you are in, let's say, in a normal bull run, then also mutual fund will outperform and this can give you moderate returns. But if you're looking for any other scenario, let's say bear market or consolidation phase, corrective phase, or range bound market or volatile market, then SIF as a product will outperform the mutual fund scheme. So, okay. So we have to look at the combination. That's the reason we are looking for things because it's very difficult to predict that this sort of environment remain forever. So when you look at, because if let's say take about 5 year cycle, then you do get 2, 3 rounds of massive, or let's say a few quarters of sharp up move and few quarters of sharp down move also. So then you have to balance it, and this product brings good amount of balancing factor in our portfolio.
Yeah, no, a point taken. And as you called it, if this is a difficult phase of the bull market, then maybe something like this will work. In a raging bull market, of course, all equity, pure equity, perhaps gets you full participation on the upside in that sense. Now, will the types of skill sets required, right, to do this, are they different, Sandeep? I mean, you've in your earlier avatar run a very large prop book as well, right?
Yeah.
Are the skill sets required, are they different from a typical mutual fund portfolio manager?
Prashant, the most important, and yes, I think skill set is very important. And the most important aspect is the mindset, because we, majority of people have grown with a traditional long term and talking about completely conventional way of doing, where you have 100% flexibility. That sort of approach, you will find it very difficult. But I always believe that as something new comes up, people do get groomed and maybe initially people will be struggling to get the right talent because this sort of experience is slightly missing right now. Obviously, we have run very large prop desk in the country for 10 years. We ran that product, so we have that mindset. But I'm very confident it will get built, because youngsters are coming. This is all about we are living in technology world and AI ML sort of thing. A lot of high tech quant models are coming. Behavior pieces are getting built. So youngster will able to fill this gap. Maybe some of the people who are relatively old may not be able to fit this bill, but I think youngster will take this role and they will take it to the next level.
Yeah. No, no, absolutely. And point taken. Sandeep, tell us a little bit about Quant's own strategy now in terms of how this is, what are the frameworks that you've developed? I think you've come up with something called the Markov way of, is this a is this an investing framework? Is this risk mitigation? Talk to us a little bit about how you're thinking about doing this, since you will be perhaps the first to launch the product as well.
Yeah. So, Prashant, let me just give you first perspective. Let's say how we look at investment first, and then come to the traditional. I'll come out to the markup also. So, when we're talking about investing style, when we run a mutual fund or traditional long account, what we call it discretionary active. It's the discretion of a. So, these are known as discretionary active investing thesis. Then you have a passive investing, which is largely a passive fund, and mimicking the indices. And then we have a third category, which is globally evolved known as systematic active investing, which is somewhere in between the discretionary as well as the passive. Basically, this is the evolved version of a quant model, how quant became quantamental when you combine fundamental and sentiments. That's the way quantamental got built. Now you add the risk element. That also get added. Then that's the way it becomes a systematic active. So when we talk about, let's understand systematic active, the way we define it, is very important. Then we'll come to Markov. When we're talking about systematic active, the word active is obviously there, which means it's a very going to be very active fund. When you talk about systematic, it means we are putting some amount of control, some amount of boundaries. So when we are saying this will not do in this environment, this will not do ever, basically we are putting some restriction. When you put restriction, you're bringing down the risk. And obviously, you're also reducing the probability of the returns. That's the first aspect you have to understand, that this product has certain limitation. It has been designed. Now you can run the SIF the way you want to run, like a normal mutual fund. You can have that flexibility, and regulator has given that. But the way we are positioning this product, because we have option to use the 25% shorting opportunity, hence we thought we should use for risk mitigation, and looking for alpha by shorting opportunity is a better way. The way we build VLRT framework for our discretionary active strategy, we have built a Markov thesis for our what do you call it, SI framework. When we're talking about systematic active strategies, that it will manage through Markov. When we talk about Markov, basically what Markov is going to do, it's about high frequency. So we are bringing a lot of high frequency analytics. Let's say in mutual fund, what we do when we talk about quarterly numbers, monthly numbers, bi-monthly numbers, these are largely low frequency data, because in mutual fund, when we say we are long-term investor, 1 quarter or 1 month will not make any meaningful difference in the longer term perspective. But when it comes to SIF, when you're trying to look it for a special situation opportunity, you're trying to look for a limited alpha, and you have to keep on accumulating the alpha, then these low frequency thesis will not be very effective. That's the reason we are bringing high frequency analytics, and we are saying that in our SIF will use 70% of high frequency analytics and 30% low frequency. That's a combination. Now, for this high frequency analytic, we are bringing the concept of Markov. Basically, what it Markov talks about, it is all about how we're getting into micro market structures of the market. That's a M represent, A represent for the alternative data that we talk about, R risk for the risk analytic, the C represent for cycle analytics, and V for the volatility analytics, and O for the objectivity. What is very important is that we have to define everything in a very objective manner. There's no scope of subjectivity which can build in the system, because you are trying to look for a short term and medium term opportunity. So we are very clear the way we are positioning this product. We have a mutual fund scheme, very clearly long term product. There's no debate on that point. This product is largely meant for for short term and medium term horizon. We are trying to look for short term opportunity, try to accumulate alpha from longer from a medium term perspective, and basically cutting down the risk. So our entire positioning, we are not positioning this as an absolute return product. The way we are positioning this product is the low walls. Basically, I'm saying your overall portfolio volatility will come down, drawdown will be lesser, and we run in a more risk averse environment sort of thing. That's the way this entire positioning will be. So obviously, it's a combination. It gives me better, superior risk adjusted return, just rather than looking at purely in isolation.
Very, very well explained. Sandeep, very briefly, and we're running out of time now, for as when you put it out and you market the product, right? What's the promise to investors? Is it that, well, it's going to do better than your regular mutual funds? It offers protection. What's the hook in that sense?
Yeah. So as I explained you, Prashant, that we are talking about, we for us absolute returns are very important, but and I think like relative is more important.
Okay.
What we are trying to showcase, in different environment, these products will run differently. The returns will be different. I say if you're raising bull run, by default this product will underperform. So, but if you are, let's say, the type of environment which we have seen in last 1 year, and somebody could have told me last 1 year back this product would have been launched, then this product would have outperformed the existing mutual fund scheme. That's the way I define. So depending on the what type of environment we are looking at, that's the reason I'm again harping and saying that don't leave this product in isolation. You can buy in isolation. Answer is yes. But combination will make a lot of business sense and portfolio better risk adjusted opportunity, and hence it's a combination which bring down your overall risk in your portfolio, and it give you a mental peace. See, because what happened in last 1 year, sometimes the mid and small cap, the drawdowns are very large. And
Yeah.
if you have one product in this category, we second product which we're launching will be on the SMID side, where we have long short on the small and mid cap portfolio. So we, if we have this facility where I can hedge 25% of my portfolio without owning these names, then obviously it will help me in the drawdown. So purely from a risk perspective, I'm able to cut down my beta significantly, and hence it becomes a slightly better product in this sort of environment.
Well, that makes sense. Use it as a combination and not as a standalone kind of product when you put money to work in the market. Sandeep, wishing you all the best, and to you and the Quant team as you launch the first off the block. And we look forward to chatting with you once it's already once it gets out into the market. Thank you very much for joining us
Thank
with
you, Prashant.
useful primer explanation of how the product works overall, and of course what Quant plans to do here as well. I think completely out of time. We're going to take your leave here. Thank you very much for staying with us here on another episode of the Global Reset. More comes up in just a bit.